Look, for those of you who I haven't met, my name's David McCready. I'm the Chief Executive of the Australian British Chamber of Commerce. It's my great pleasure to welcome those of you who have joined us in the room today. I think we've had several times in the conversation how good it is to see that people are actually 3D again after so many years of 2D. But I can assure you, those who are watching, we are all three-dimensional here. So on behalf of the Chamber, welcome along to this session. We're delighted to have a really strong panel who I'll introduce in a moment, but I'll take the opportunity just quickly to acknowledge the traditional owners of the land on which we meet, not just here in Brisbane, but the lands that you might be joining from around Australia, and acknowledge the ongoing custodianship of Indigenous peoples, be they Aboriginal or Torres Strait Islanders across the country, and their continuing connection with their ancient culture, of which we should all be very proud. I'd also like to acknowledge any elders, past, present and emerging, that might be joining us today, either here in the room or online. So we've got a panel, and when I was looking at the names, I thought it's unusual for us. I'm going to make this point. There's no woman on the panel, so I thought we could be a boy band. With names like Troy, Brendan, Brian and Dave, I reckon we've got a chance. It has a ring to it, don't you think? I think there's something there. But if I may, we'll start off. Troy Setter is the CEO of the Consolidated Pastoral Company. I'll get him to tell you a little bit more about that in a moment. Then Brian Healy, a partner here at K&L Gates, and Brendan Goulding, a director at international services at Bentleys. I'm going to get them to introduce themselves briefly in a moment. But it's terrific to have you along. We had a really good pre-briefing chat on Monday and realised that the amount of stuff we have to cover in the next hour, we might need about 3 weeks, if that's okay. I'm sure we can bring in some sandwiches later for those who might need it to get through everything that we've got to get through. Could I also just take the opportunity to thank the sponsors for today, and two of them are represented on the panel in K&L Gates and Bentleys. It's terrific to be able to have great partners, and without partners, we just don't run events. So thank you very much for your support of this particular event and your ongoing support of the Chamber more broadly as well. So in terms of today's running order, I'm going to shortly hand over to Brian, who's going to make an introduction. And then I'm going to moderate a panel. Like I said, we've got lots to cover, so I'm going to be quiet now and pass over to Brian. And then at the end, I'll ask Brendan to give us a bit of a wrap up and tell us what we all should have learnt from the previous hour. And then we'll have, for those in the room, we're going to have some networking and drinks afterwards, which is why you should really come to the room, right? Anyway, without further ado, Brian, I'll pass to you. Just press the button. Yep.
Thank you, David. Now we're on. Thanks for that introduction. It's probably a middle-aged boy band, I think, if you look at the shirts. This wasn't coordinated in the briefing, but this is the way middle-aged men dress, isn't it? So, welcome everyone to K&L Gates today. I think this will be a very interesting presentation and panel discussion. Brendan was saying I was the rose between two thorns, and I think that's right. Troy will have some really fantastic insights today at a commercial level and practical level and an industry level about the opportunities available as a result of the free trade agreement, and Brendan from an advisory perspective, and I'll chip in a little bit as well. But we had a really good discussion on Monday, so I hope you all enjoy it and find it valuable, and we're relaxed and can have a good discussion. I was thinking this morning that my little introduction is freestyle, the words that I used, but I think, you know, there's a danger here that it might be free fall, but let's see how we go. The sector we're talking about today, of course, is agriculture. For many people in the room, that's our passion and where we live our lives. Certainly for the three of us it is. The background to this is that the UK is Australia's 5th largest trading partner, and I think both countries see terrific opportunity going forward for agriculture, trade and investment between the two nations. We'll get into nitty-gritty, of course, but it's hoped that there's great trade liberalisation. Whether on the ground that is executed is another story. But for me, a very exciting part of this is that investment obviously often follows trade. And I'm really hopeful that this will expose the UK to the investment opportunity in Australia's agricultural sector, which I think is absolutely fantastic. But I think from sophisticated UK investors, I think there is terrific opportunity. Probably wouldn't have much of a beef industry without UK investment into beef. So that's what can be done. All the themes are there. We've talked about this for years, but it's finally coming home to roost. You know, a growing middle class in our region, which is eating better quality food, clean, green, niche, premium product, which is what this country is capable of. So the investment opportunity is definitely there. And history tells us that between Australia and the UK, we know how to do business together, we know how to do it well, and we can talk about and share in the opportunities. So that's always important as well. The thing that I'll probably focus on is how, certainly as professional advisors, we advise from what I call concept to execution, and that's about getting the team right. So if we've seen plenty of people come from offshore to invest in this sector, and we've seen them, to use sort of colloquial language, do their dough or lose their shirt pretty quickly. And that's been because they haven't had the right team, they haven't been well advised, they haven't taken their time. And part of what today is about is making sure that people latch onto those opportunities from the UK and get that all right from the start, and it becomes a good experience for everyone. So that's enough for me in terms of an introduction. Once again, thanks very much for coming along. It is freestyle, interrupt when you like. It's probably not the right way to express it, but I think you know what I mean. So thanks very much, David.
Thanks, Brian. Yeah, sure, I've taken stuff off. I have, so now I'm back on. I worry because I'm a mouth breather, so I tend to dominate the audio online. So apologies for that in advance. Thanks, Brian, for that overview and introduction, and where you'll be coming from today. Troy, CEO of Consolidated Pastoral Company. That doesn't sound like the sort of job that you do on, the weekend. It sounds like it's got a fair bit of heavy lifting behind it, and clearly plenty of international investment. Do you want to give us a bit of an overview of your firm, but also how you sort of see the lay of the land as it lies now, and we'll unpick a bit of what it might look like in the future thereafter?
Yeah, certainly. David, thanks for the opportunity to be here this afternoon. So I'm, as I said, part of the Consolidated Pastoral Company, or CPC, team. We originally were the Packer family investment in agriculture, hence where the Consolidated name came from. And when the family got into some challenges during the GFC and their first challenges with casinos, we were sold off, and that worked well for the family. If you look at why we were established, one, we were interesting, but two, we were there for challenging times of something that could be divested, and quickly were into terra firma. Terra firma, based out of the UK and Guernsey, raised a global fund, but invested in North America, the UK, Europe, in relatively asset-heavy, fundamental businesses. I think it was about €9 billion equity fund in 2008. So, and we were there as a offset to some of the riskier things like renewable energy, music, healthcare, all sorts of fundamental things, and stayed in that blind pool, big lumpy fund until about 2018-19, and was starting to hit 10 years and got divested. We sold off about a third of the assets in Australia, and then the other 2/3 were bought by Guy Hands, who owns terra firma, and so bought us out of the private equity fund into his private family office business. So we've got a unique, I suppose, outlook, having been in the pure private equity space to now private equity family office type space in terms of how we've thought of and managed. So we have about 3.5-4 million hectares of land across northern Australia, 300,000 cattle, 2 feedlots and some farming operations in Indonesia. And then we also have some cropping and farming, a bit of cotton and a bit of agriculture that's growing on the properties, and we do some work in the carbon space and looking at other opportunities there. We're certainly a growth part of the family investment, and balance up against other investments that they've got in the UK and Europe to give an overall family portfolio. So,
Brilliant. Thanks, Troy. And I look forward to unpacking a bit of that as we go forward. Brendan, Bentleys. Tell us a little bit about Bentleys as a firm, but also particularly your role in the international investment space.
Yeah, sure. Thanks, Dave. Look, I'm Brendan Golding, head up the International and Transaction Services Advisory team at Bentleys. Bentleys, we've been around for over 70 years, actually. So we're a full-service accounting and business advisory firm, just based up the road here from the office on Albert Street. So essentially, the type of work that I do, as I touched on, a lot of it is around M&A, around agriculture. So our firm, we have quite a few clients in the ag space. It's about a third of our ag book, and it's a really big part of our business. So a lot of us live and breathe it every day. We work with a range of clients across beef, cotton, broadacre cropping, horticulture, dairy, etc. And the area that I work in is working with those clients who are interested in looking at investment partners, whether it be joint venture partners or looking at acquisition type deals to either strengthen their business or look at divesting out of it. So that's a lot of what I do on a day-to-day basis. We're fortunate as well that we do also advise institutional investors that invested in Australian agriculture from the likes of the US, but also the UK. And the type of work we do with them is looking at working through them their existing investments in terms of managing them from a financial perspective. So things like financial reporting, structuring, due diligence and other opportunities they're looking at once they get a foot in the door here in Australia, and helping them on that journey to make sure what they're looking at aligns with their goals and they get out of it what they're looking for in the future. So that's me in a nutshell. And thanks again for ABCC for working with us today as host. It's something that we've been talking about for a long time pre-COVID, so it's just great it's come to fruition today.
No, absolutely, and thank you very much for your long-term support of this event. It has taken us a little while to nail the brief, but I think we've got a really good chat coming up. So, Troy, you mentioned about the investments from offshore, but I might go to Brian first because you mentioned something that I'm really keen to sort of work through very early, which is there are some people who aren't necessarily the best advisors in the world, but if people are interested in Australian agriculture, why is that? Why should UK firms, why should Australians actually be interested in investing in agriculture as an asset class?
It's a great question, David. I mean, when I was preparing for this, I reflected on, I think it was Larry Fink, was the BlackRock CEO at the time, who said maybe 15 or maybe even 10 years ago, go long on agriculture, buy investments, put them in your bottom drawer and forget about them for 10 years. If you had followed that advice, you would have done extremely well. And if you are well advised in this asset class, then you'll outperform. We all knew it was coming, and we all knew that population around the world was increasing, wealth was increasing, diet was changing, and all the thematics are there. People need to be fed and they need to be clothed. And as their means advance, they want to dress better and they want to be fed better and more healthier. So it's all there, and this location in Australia is the ideal place to do that. Great assets, great regulatory system, secure, great place to live, easy people to do business with. Agriculture's day in the sun has really come. We had a somewhat sleepy sector for a long period of time, but when you inject capital into it, its day in the sun has come. So it's been discovered as an asset class. More are still discovering it, and there's a story to tell. For example, the Australian super funds say, well, you explain agriculture to us, and if you can, and you do a good enough job of explaining it to us, we'll consider investing in it. But so that's the challenge for the industry. But to me, as an asset class, its day has really come. So,
Troy, clearly you've got backers from the Northern Hemisphere. What has been attractive about it for them? Is it just we have boundless plains to share, as our anthem says, or is there something more behind it that, in terms of a structure of how they're investing across the world, that really makes it more attractive than just expanding whatever the footprint is in Europe?
Look, I think if you look at some of the reasons why people invested in us in the old fund, and then why Guy has continued, they're the same reasons today. And a lot of our investors would have stayed, except the fund came to an end and it needs to be divested of. But the big macro trends of less arable land, less grazing land, more people, less water, wealth, all those lines were crossing over 10, 15 years ago. But it takes a bit of a lag for those things to happen. And as Brian said, we started to see some of those things click into place in the last couple of years. Just before COVID, we really started to see some increases in food and shortage. But we also have seen a recognition that Australian land was very cheap compared to global land. And it still is. Now, we sit here in Australia and say, oh my God, land prices have gone through the roof. We've seen central Queensland land triple in price in some areas in the last 15 years and double in the last 2 or 3 years in some areas. But you bring that back and you compare it to comparable land in Texas, or you compare it to comparable land in parts of Europe or parts of Africa, it's still pretty cheap. So there's some really fundamental things there. I think water is really interesting. But the other reasons why I wanted to invest in Australia is one of the only large food agricultural producing nations that's really close to Southeast Asia. That's never going to change. Brazil's never going to get closer. So we've got some competitive advantages there, but we've also got some cost challenges, and that can be offset partially by our clean and green, but it also can be partially offset by the lower cost of entry into Australia and the more stable investment environment, but also the rule of law and things in Australia. So you've got huge population in Asia, huge population in the subcontinent, in food, and Australia's a good place to get exposure to that macro thematic without investing directly in Asia. Now, we're a little bit different. We have direct investment in Indonesia. It's quite a large part of our business, but we had a couple of investments in China. They were really difficult. We had the wrong partner. It took up a lot of time, but we've got just as much benefit nearly from being exposed to the Chinese market, but having the stability back in Australia. I also think, and you said about boundless plains, it's pretty interesting. Like I was in the UK 2 weeks ago, and in our group of businesses, there's all sorts of things. There's lots of housing, there's hotels, there's all sorts of businesses. Our one's really interesting to talk about. Like it's really interesting. It's complicated. You got weather and environment and all these sorts of things that I'm sure we'll talk about that make it hard. But it's actually really interesting, and it's exciting, and it's not mainstream. So for our investors, that was actually really interesting. And then for our ultimate owner, Guy Hands, he was out here 2 months ago, so I just loved it. It was just so interesting. The people are interesting. What we can do with ESG, what we do with developing people, what we can do with environment, what's possible with carbon long term. All those things are, don't underestimate how interesting they are, as well as good investments. We're staring at a screen and watching share prices and watching investments in more traditional investments is good, but it's not that fun. And that's part of it. Part of ESG in a balanced portfolio. I think that balanced portfolio is really important, and that and agriculture does fit that quite well.
And you mentioned environment and weather, and obviously, if you're in Australia, it's probably a different environment and weather pattern than the Northern Hemisphere. Brendan, if I can just come back to you, one of the things that, I've been doing this job for 12 and a bit years, and people go, the UK, it's such a traditional relationship, all the money and all of the relationships, they're all historic and so forth. You're at the cutting edge. People coming in, people leaving. How true is that in your experience? And, if people are thinking of investing, do we want to, I can't imagine it's all locked up and tidied away and never to see the light of day, despite the fact that the two gents to your left have just said, if you've got it, hold it and hold it for a long time. What are the opportunities that you're seeing at the moment? Is there really fertile opportunities for people to come and invest in Australia right now?
Yeah, absolutely. Look, I don't think there's been a better time, to be quite honest. Picking up some of the points that Troy had mentioned, I mean, it's interesting. There's a lot of varied opportunities, both at a small scale and large scale, a huge scale, in wildly different types of industries. So, for example, the types of clients we're working with at the moment that actually have live opportunities that are looking for investment partners range from everything to beef cattle, through to production of horticulture under glass, all the way through to poultry. So there's a really wide variety of opportunities there in different types of industries with different risk return profiles, different types of asset production systems, different geographies and climatic zones that that offers real choice to an investor if it's someone from here or on the other side of the world in the UK. So there's a plethora of opportunities, and we find that that's quite interesting to investors. And the other point, just touching on what Troy was saying, watching a share market portfolio go up and down, ag is a little bit different in a way that it doesn't necessarily move in the same patterns or what they call correlation in the financial world. It tends to be a bit uncorrelated from your traditional types of asset classes, from say share markets or office buildings, that sort of thing. And we did see a bit of that in the pandemic, where share markets were falling and things were happening with valuations and other assets, whereas ag, it actually went the other way. Commodity prices went up, land values went up. So it's a really interesting asset class for those investors that are looking to diversify out of some of the more traditional parts of their portfolios, so to speak.
That's a really good point, and I think it's probably part of the reason why we wanted to do this panel in the first place. Is it's just something that a lot of people sort of, I guess, have the idea of, but don't know how to get involved. And Brian, I might ask you, and perhaps sort of draw a couple of different points together. I might start with this one. We've heard a little bit about from Troy in particular, about the location of our market being close to Southeast Asia, India, other markets geographically where we can export our goods. And I know that in your opening you mentioned about investment often follows trade. What's the likelihood of Australia exporting huge amounts of agricultural product over to the UK, as we did in pre-70s? Australia exported a lot of stuff to the UK. And how much is it really more about looking at the UK investments into Australia, taking advantage of that much more proximal market to the Australian geography?
That's a really good question, David. I'm not dodging the question, but I think Troy will have an interesting perspective on this. But one thing we find is the investment opportunity might outweigh the theme of sending product all that way back to the UK. So one of the things we find is that investors come here with a certain intent, and it doesn't work out that way. And things change along the way. So there have, for example, and this is not what we're talking about, of course, but there have, for example, been regions that have looked to invest in Australia to secure food supply back home, which is problematic can be problematic under our FIRB regime. But what happens is they then come here, they're then on this doorstep of the world's most rapidly growing region and rapidly becoming affluent region, and it makes much more sense to export into that area, and also the asset class the investment in the asset class itself just becomes compelling. So it becomes about finding best assets and taking gains. And so the investment that follows, there will be the trade component, and there are practical issues that, Troy is probably going to expand on, but and geographical reasons as well. But plans change, and we're on the footsteps of a great region to take advantage of. So.
Troy, it feels like Brian's just flicked you the ball, mate.
Yeah. He's done the hospital pass. I suppose if you look at a high level, and there's a UK EU free trade process well underway, and the UK process hopefully gets signed up soon. But Australia exports about 70% of our agriculture, and 80% of that goes to countries we've got a free trade agreement with. So there's certainly upside if you look at statistically about how we trade with the world, with the UK, for more product to go to the UK. So Australia is one of the biggest beef exporters in the world, and 0.8% of the beef we produce in Australia goes to the UK and Europe combined. It's 1% of the beef consumed in the UK and Europe, so it's insignificant. There'll be people out there that are EU and UK beef producers who would, throw more than the hospital pass at me for that statement, but it's really insignificant. But that means there's a lot of upside, there's a lot of potential. But to get there, you've got to sail past Asia, sail past the Middle East, sail past UK, and I'm not meaning to give people suck eggs giving a geography lesson, but you've got to go past some really good markets. So that means the UK's got to pay a fair bit. But if you look at the policies that are coming into the UK at the moment about reducing domestic food production, increasing the barriers to entry for products out of countries that probably don't have the best ESG or carbon footprint, or measuring of that with reliability, that's going to create some opportunities into Europe in the UK for Australian agricultural products, particularly on a seasonal basis. So I don't know if anyone's spent much time in the UK. It's the middle of winter and you go in and you can buy beautiful berries. It's the middle of summer, you can go and buy beautiful berries. Like, it's such a global, all foods are available at all times. That's the culture of the country. But I look at our business and say, well, our family office group in Europe does 800,000 burgers a day. We do, I don't know how many beef meals a day we do through the 20-something hotels and restaurants and things. We don't send a gram of beef from CPC in Australia to either of those big business groups in the UK, but we're a hedge on the beef price. So those businesses have been paying increased prices for beef and chicken and increased prices for grain-based burgers, buns and bread and all of those sorts of things. We're not supplying them at cheaper, but we're a hedge offset that because we're benefiting from it on this side. So I think from a vertical integration point of view, it may not be as much food verticalization, but it may be a UK fund that invests in food distribution or food production or fibre in UK, Europe and US that also invests in Australia on the production side or the further processing side, who can offset and balance their portfolio and have a production hedge and a market hedge around the world in different environments, and put a currency hedge in there as well. And I look at our group, and that certainly is helpful there as well.
Just on the FTA, given that's meant to be my area of specialty, I'll jump in and pretend I'm a panellist for a moment. So just so you're aware, last Thursday, the federal government put into the House of Representatives the enabling legislation for the FTA, which needs to be passed and duly signed off by the Governor-General before the FTA can come into force. There's 2 sitting weeks left to go of the parliamentary year. They're determined to get it done. The Joint Standing Committee on Treaties, who are currently doing their review of the FTA, which is of course a treaty, the Free Trade Agreement, will report on I think it's the 18th of November, Friday in a couple of weeks. So that's before that last sitting week, the last pair of sitting weeks. So they're very confident, particularly given the coalition actually negotiated the FTA they're fairly confident, and rightly so, listening to my friends on the other side of the House as it is now, to be able to pass that without question and without problem through both the Houses of Parliament and get it done. The UK side has been a little bit more interesting of late. Don't know if anybody's been following, but we're up to our third Prime Minister of the Year in the UK, which has made things a little bit more challenging, but the fundamental business of government has been rolling on, and their process is going to take a little while longer. They've got to go through the House of Lords. It's in committees and things, but again, their enabling legislation is in the process of being passed. I suspect it will just take a little bit longer than us, and we'll probably wind up with sometime, hopefully early Q1. I'm always an optimist. Early Q1, maybe mid Q1, to actually get an implementation date and a date that we can actually start utilising the benefits. So we're not far away. So there's some good pieces to that. Brendan, Brian, I'm not sure who wants to field this one first, and I'll see who jumps in on the microphone button first to buzz in. But when the FTA does come into place, and Brian, perhaps you want to have a first stab at it, so I'm doing my job as actually pointing out somebody to talk. What do the changes that the FTA enables allow? We know that, particularly for red meat, that we've obviously talked about a bit today, that comes off over a period of time. But what from day one will be enabled, and what benefits do you see that people should be being prepared for now, given we're not far away from an implementation date?
Look, I think there's some immediate reductions of tariffs across some commodity sectors, and there are some FIRB changes as well, but they're not likely to impact agricultural land thresholds. So that was probably a great hope that there'd be more, the screening thresholds would be higher for agricultural land. Doesn't appear to be the case. So I guess they're the major changes immediately. On a sort of sentimental level, I'm hoping it just sort of signals to the UK that Australia's open for business and come on and get a part of the action, certainly in that investment space.
When you mentioned FIRB, and just for any friends who are joining us from the UK and haven't heard that acronym before, that's our Foreign Investment Review Board. What's the process like there? Is it something which is, that's going to make this really difficult and potentially not worth doing? Or is it something which is relatively straightforward, obviously with good advice from a firm such as yours?
Yeah, that's a great question, David. There are a lot of people in the room here who have good experience with the Foreign Investment Review Board process. I call it a process, and I actually think it's a good process. We deal with FIRB all the time, and their opening statement is, look, we're encouraging of and positive about foreign investment, and we want inbound capital. It's changed what was our sleepy agricultural sector. There'd be a lot of people in agriculture who wouldn't have jobs if it wasn't for foreign investment, and that's the attitude of FIRB. The downsides, and I don't necessarily see them as downsides, is that it is a process. If people are ill-advised, the process can be made a mess of, which will result in more delay more than anything. But there can be hefty application fees, and they've increased in the last few weeks. They've doubled. The new government, I won't say the Labor government, I'll say the new government doubled them overnight. And there can be at times delay. There can be sort of 3, 4, 5, 6 month processing for applications, although that seems to be getting a bit speedier. But if you know the process and are well advised, it is just a process to go through. Some people can miss out on investments or assets because there are domestic buyers who don't need to go through that process. But generally, the inbound investors have a premium on top, and it's worth waiting for. And we always say, I'm really rambling a little bit here, but I always say, and this is dangerous as a legal advisor, you'll get your approval. What are you worried about? You can guarantee me we'll get through. I say, well, I'm not going to guarantee you, but I guarantee you it's a process. I obviously won't say that in controversial cases and there have been a couple, but it is just a process to work through, and yeah.
Yeah, I'd certainly agree with that. I mean, the vast number of applications that go through FIRB, to your point, is a process, but it's about finding the resolution to any issues that are in there and getting through it. And they are quite keen to see the investment here, and are happy to support you generally to find the right avenue to make that happen. There's not been many things that have been knocked back by FIRB in the whole history of FIRB, so it's worth pointing that out.
And I should, sorry, David, this is one of the key elements of your question. I should say, not in a self-interested way, although it doesn't hurt. You do need the right advice. What we find in this sector, and particularly in relation to FIRB, is that sadly we see some investors have inexperienced advisors, and what can often happen there is they're paying to learn on your time. They're making the mistakes on your time and your matter. They'll know next time, but you're the one that's going to take the burden. So assemble a team right throughout a project of people who properly specialise in the agricultural space, and do it properly. Respect the assets, and respect the process, and you'll be fine. And the advisors should be of that calibre as well. They should respect the asset, respect what you're doing, and respect the process. So.
Brendan, as somebody who works on these sorts of transactions, what's your take on where we're up to with FIRB, but also expanding, I guess, on the conversation we're having around that?
Yeah, look, I agree with Brian. It's and your comments as well, David. It is a process. There haven't been many instances of where applications have been rejected in the history of the Foreign Investment Review Board when it comes to agriculture investments. I'd say, also building on both of your comments, the overall environment is very welcoming of international investment, wherever it may be from, in this case, the UK. The federal government is very welcoming. You go into markets overseas like the UK, they're very active over there in engaging with investors. They'll get you engaged with investors in that part of the market, get you in front of them. We have some great colleagues from the Queensland Government here today, and again, just shows their interest in this area, and also sends the message that the Queensland Government at a state level is obviously very welcoming of international investment as well. And I've had some great interactions with the Queensland Government in markets like the UK as well, in terms of facilitating that conversation with investors and talking about what the opportunities are here in Australia. So overall, the environment's welcoming, and you shouldn't be afraid to look at an asset class like agriculture, even though it could be in Australia on the other side of the world. There's plenty of examples of it working well, and plenty of people here wanting to work with investors in this sector.
Troy, I'm going to ask you the next question, but is there anything you wanted to chip in on that point?
We've had these guys have got professional confidentiality that they need to probably about their clients. So I can talk direct about what we've done with FIRB and what we do. So we've put projects and whole of company twice through FIRB and multiple properties. The whole of CPC went through FIRB in 18 months ago in about 50 days. We've got sensitive military assets. We've got sensitive environmental assets. Being UK owned helps, but it's not a silver bullet. The ultimate investors need to be prepared to show all their details to FIRB. As Brian said, with the right advice and the right format, have a meeting with FIRB, explain what you want to do, be totally transparent, bring the manager of the business into it. It's not just about the owner, it's about the manager as well with FIRB. So that's myself and our team. The reasons that FIRB want to check you out is there's a national security. So understand the national security asset that you're buying, and it not necessarily is saying, oh, you're going and buying a defence airstrip. It could be in an area where defence or telecommunications or other national sensitive things are done, very, very rarely, if ever, it's knocked back, but that will take longer. You need to understand what's in the region, what's in the area, and answer those questions up front and talk about your transparency and things like that. Australian management is not essential, but it's certainly helpful. And also, why do you want to invest in Australia? Being really transparent about whether it's buying a whole company or it's adding assets on. So we bought a station the other day. FIRB really wanted to understand how many local jobs would we create, and we're going to create 2, but that's 2 above 1. Mm-hmm. And they were really excited about it. They're going, wow, you're going to create, you're going to triple the workforce and stuff, and go through, what are you going to do with the local community? And it's not necessarily about, we're going to go and fund the local soccer team. It is, we will try and buy locally where we can, but we're going to run a commercial viable business, and if the local people aren't as good at providing price, we'll go and buy from a. So they're really practical questions. So I think FIRB is not a problem, but get organised, be open, be transparent, and you won't. It's not a bad process.
I think that leads really well on to the next question I wanted to ask, which you touched on actually earlier in your opening comments, which is around ESG and how we see ourselves, but also what's the role of ESG in the conversation with investors. I mean, the last probably 2 or 3 years, 2 or 3 years ago, pre-COVID, ESG was sort of bandied around a little bit, but not many people have heard of it. We've now all heard of it, but most of us haven't really grappled with it yet. So in terms of agriculture, what does it mean? And in terms of, for investors, what's the plus side that you see around that in your experience?
I think if I look at the feedback I get from our team in London, in particular in Guernsey, is what we do every day is day-to-day in our businesses and our operations as Australians, and then as Australian farmers, we don't see as ESG. So, we go, we've got an Aboriginal community on our property, and we give them a few cattle, and we go and help the kids, and if they're having trouble getting to school because it's wet, well, that's a really operational example. Or, we're in land care, we let the land care groups come in and we do, salinity work on our farms, or, we will help the local community do this, or, we have all these government's requirements, we meet ASX principles. Our social engagement might be that we take in work experience students. We do so many things as businesses in Australia that actually fit very, very broadly across ESG, and we don't think of them as ESG. None of us think about the graduates or the university students or the high school students that come and do work experience in our businesses as a social good. We just do it. That's Australian culture. So when you're talking about ESG, you've actually got to talk up what you do to outside investors as normal, but then also what are the additional things that you can and do. And was really hit me again a couple of weeks ago, just talking about what we do in our business normally in Australia, and a lot of the UK investors saying, or UK participants saying, wow, that's amazing, that's so much ESG, and we think it's normal. The other thing that we have an opportunity in Australia now for is to get economically rewarded for it. So we've seen multiple banks have lower cost interest or lower risk ratings on companies that do ESG well. We also have emissions reduction trading platforms and schemes in Australia to get economically rewarded for that. And we also have these growing biodiversity credits as well. And so that, I find that's really exciting, but you've actually got to explain that to potential investors pretty well. And that all of that fits together pretty nicely in a package. Last thing, I remember when we were raising money a few years ago with CPC, and raising money for agriculture is hard. You go into a room with someone and someone's got an uncle who they used to go to their place and the Christmas was really bad and they never had any money and it was a drought, or you get these people, there's always that person in the room. But sitting there with some really sophisticated investors in the US, and we explained our business for about 4 hours, and they're like, I still don't really get what you do. And then we started talking about some of the ESG things we do, and that we just do as natural as part of our business. And their chief investment officer said, If you've got time to do that and you can afford to do that, you must have a really good business. We're really interested.
Yeah.
And it was a really good way to sum up how, some of the particularly North American investors were thinking and going, if you've got time to do ESG properly, yes, your business and your industry is complicated, but it's a really good test of the quality of the business.
And you touched on earlier, and I might ask Brendan, because Bentleys have done some interesting work around creating a carbon fund. But some of those practices that I think we as Australians kind of go, well, no surprises here. Geez, got to be careful what I say when I'm on camera. No surprises here about why we're doing this. It just makes sense and it's the right thing in our environment. But you also mentioned about sort of, actually recognising that and maybe getting even paid for it. Do you want to tell us a little about Bentley's Carbon Fund and what you've done there?
Sure, yes. So, look, we over the last 6 months or so have been working through an opportunity that, given our exposure to the ag industry and a whole range of clients, particularly in the beef sector that we work with, we had an opportunity to look closely at a business that basically is involved in assessing carbon generating projects, working with landholders to look at working through aspects of their business in terms of agricultural production, whether it's livestock production, and looking at opportunities around basically implementing programs in order to reduce their carbon footprint and be able to generate ACCUs, so carbon credits essentially. We see this as a big theme going forward, obviously. Around this opportunity, we thought it was a good idea to put some skin in the game, so to speak, ourselves, along with other investors that came into us under the fund that we created through our AFSL. So essentially, we've aligned ourselves with a carbon credit business that essentially advises producers and landholders how to go about making changes to their business in terms of land management practices, livestock practices, etc., to be able to reduce their carbon footprint and be able to earn ACCUs. And essentially, we've looked at aligning our business to that, investing into that business, and the overall objective of not only will it help us but help our clients going forward to be able to be aware of some of these types of opportunities out there and to be able to make change in their business to reduce their carbon footprint. Brian,
I'm sure you've probably got some great examples from your clients as well, but it's probably worth mentioning as I pass to you that the Australian red meat industry has a pretty ambitious net zero by 2050 target, which I don't think most people are probably even in this room in Australia are even aware of. What are some of the things that you've been seeing with your clients along the journey around climate change and making those commitments? Have you got some good examples that you might be able to point to without being too specific and client specific?
Yeah, well, I mean, there are some terrific examples. This is a great discussion. I mean, our client base predominantly is either sovereign wealth funds, so pension funds of government, or the larger financial institutions with exposure to agriculture, or family offices. And they are, and Troy was saying this, and Brendan was as well, they are, it's a bad way to express it, all over ESG, but it's part of the DNA. And I was thinking as my co-panelists were speaking, I'm not trying to be funny, but cowboys can't be cowboys anymore. ESG is serious and it's here, and practices have to change, and it is led by industry. The way people are treating land and are custodians of land and livestock and employment and everything, and people are learning to peel. So the underlying asset is land that's used for cattle, but they're learning to peel the onion many different ways, and that throws off some, great opportunities to achieve ESG outcomes, like regenerating land or finding alternate uses that have great environmental impacts and whatnot. Troy's doing some interesting stuff. Here's another hospital pass, but with Savannah, interesting stuff with Savannah and carbon. So it's foremost on on our institutional investors' minds, and family offices are really getting exposed to agriculture, and in a lot of cases, it's because they actually want to leave. They want to leave the world a better place than they're in. For their children, and so they're looking at how they treat land and treat assets and how they can improve the world through agriculture. And there's really exciting stuff happening with, particularly cattle country and cropping country around, leaving the land better than when they inherited it. So, yeah. And it produces a buck too. It's also good business sense. And in Troy's case, I'd talk about savannah issues, that's all fabulous business. So, yeah.
All right, Troy, you've been handed another ball, mate, down the back line.
Not real good out in the backs. We've sold our first carbon in 2014. We sold about 800,000 tonnes to the federal government, and we ended up giving it all back to them. This story gets better. Because the legislation wasn't quite right, and there's still some legislative issues with carbon and forward selling carbon and who owns it and native title and land title that you need really good advice on from someone who knows what they're talking about. And there's a lot of second-hand carbon traders out there to avoid would be my advice. We didn't get caught, but I see lots of other companies go and do things.
A second-hand carbon trader's like second-hand car salesman?
Oh, probably was. but so you've got to get the right advice, and you've got to know what you're dealing with. And there's the formal market in Australia, which is predominantly the market. And a lot of people coming in from overseas don't understand that we have a clean energy regulator in Australia, and we have world-class a credit system called ACCUs, and they're measured, and they fit on methodologies that are well researched. And they've got a tangible value. Some of them have to be forward sold and collected immediately, and some you can balance sheet. But that's a good example of getting this advice. Then there is the informal market, which is pretty much how the rest of the world trades. And you produce something and you produce less, or you change your way of doing it, you get a difference, you get someone to accredit it, you can sell it. That market's maturing pretty rapidly. And we've seen some Australian companies who went and did some carbon tests in the middle of the drought and did some carbon tests in the good seasons we're having and have solved the difference. Their chickens are going to come home on that. You've really got to do it properly. So we use the beef herd methodology in Australia. So since 2008-9, we've increased our number of calves we produce per year by about 35% across the country. The reduced emissions on that we can monetize because we have less cows, producing CO2 that's not being used. So, and then we feed other products. We do different management techniques, which all go to our bottom line. But that beef herd methodology brings in just shy of $1 million a year worth of cash to our company, which is really good. And then we do savanna burning. So we will look at land that would have normally burnt November, December each year, really hot fires produce lots of CO2. We will do preventative mosaic burning in April, May when it's cooler, and the emissions difference between those from satellite mapping, there's a methodology we can sell those. If there's an Indigenous component to it, they get a premium, and then we can sell that emission and we do that off. So I suppose the wrap up is it's fairly complicated, but it's actually a really good way through the formal market of getting rewarded for doing really good things. So we've got some diesel to solar. We can claim some of those differences as well. So it's pretty exciting.
So one thing I should, from those examples is the important thing to know is, a rising tide lifts all boats. So industry practice across all of agriculture is changing as a result of what some of these investors are doing and companies like Troy's are doing. It'll lift industry practice, particularly in workforce as well. And what we're seeing is a lot of our investor clients, clubbing's not the right word, but they're sharing information. They're not in competition on this stuff. They're sharing information and sharing best practice and trying to lift the industry for investment reasons, of course, but also because it's the right thing to do. The family offices are doing the same thing. There's lots of getting together. There's lots of conferences and seminars things like that, where they freely share this information. So ESG is front of mind for serious participants in agriculture in Australia now. So
Brilliant. Now, I'm conscious that Brian at the beginning did say we're going to freestyle it a little here and that we should expect interruptions, but none of you have done that yet. So I'm going to throw to the floor. If I can, do we have a microphone or should I? I'll tell you what we'll do. No, it's all right.
Thank you. Michael Vale here. I'm just wondering if we're going to be talking about investment, whether we also talk about the return on investment, because it's growth opportunities. There's also risk decays, and I'm just wondering if anyone would like to talk about the downside risk, because some people might have expectations of wonderful things, and sometimes it doesn't happen. Thank you.
Look at those smiling faces ready to go. Come on, Troy.
I'll kick it off. I was the 5th CEO at CPC in 5 or 6 years after the private equity team bought CPC. So there was some delivery issues there, some people issues, some alignment, communication, translation, business plan delivery issues that caused an erosion of value. So it's not just market movements that can erode value. It's execution of business plan, clarity of business plan, and communication, and also some poor advice, and those things absolutely do happen. We've had property devaluations that came through the 2011 challenges with live cattle exports, the 2014-15 drought period in Australia, where there was more livestock to be sold than processing, and there was not enough rain for cropping land, caused some devaluations in property prices. And I think everyone being upfront and aware that these things happen, what do you do, being really on top of gearing ratios and things really mattered. Then on the cash returns, there's some pretty hefty and good cash returns at the moment. We run a lot of bands and forecasting when we look at our investment and returns. So what's the high side and the low side? How much capital do we need to survive, or how much cash do we need to survive like a family operator would when things go bad on the asset valuation, but also on the cash generation. Agriculture, livestock are probably at the lower end of cash generation. Horticulture is probably at the higher end. There's a really big range, and you do see investors that get capital appreciation and cash return confused. I think EBITDA is a proxy for cash in agriculture. And it often isn't, depending on the business, is really understanding and presenting out what the balance sheet changes are, what the P&L changes are, and what the cash changes are, and really understanding the drivers to those is so important.
I know you guys are vertically integrated, but talking about the beef industry itself, what sort of return on investment do you think is a fair thing across time, not at a point in time?
I think cash is somewhere between 3 and 6%. And I know that's a pretty big range, but there's twos and there's tens and out there. But I think you're in that 3 to 6%, depending on the value of your asset and also the cash generation of that cycle. If you look at land prices for the last 20 plus years, they've been in Northern Australia have been above 7%. And we stack those together, but they're not 7% year in, year out. There's some 15s and there's some -2s and 3s and things, but we present and manage those separately and be really clear on the separation.
Brendan, do you want to chip in on that, given valuations are part of the transaction game?
Yeah, look, I think just really to break it down in a very simplistic manner, ag has some nuances that other asset classes don't have. You're dealing with weather cycles, you're dealing with global commodity cycles. So when we talk to investors that are looking to understand the asset class and the downside risks to it, if they're looking to come into an Australian agriculture business, let's call it a beef cattle business or a broad ag cropping business, and they're a private equity fund out of Singapore or something like that, and they're wanting to get in and out in 3, 4, 5 years, we typically say no. That's not really the time horizon that agriculture, as an asset class, should really be considering because of those nuances and those cycles. And we tend to see it play out over a 7, 8, 10-year time horizon. So it's got those types of nuances that other asset classes don't. Management, like in any type of business, is important. Agriculture is certainly massively important because you're dealing with biological things. Like you can't just go and stack them in a container in the corner or whatever if they don't sell or whatever or store them. By and large, you're dealing with biological products, livestock, for example. And you have to have a good management team to know what to do when the situation turns against them, whether it be weather, whether it be other mitigating factors. So they're the couple of things we sort of break down in terms of the risk profile and trying to get people to understand the risk, in terms of commodity prices, weather, management teams, and assets. Fundamentally, a lot of ag is based on land. It's a land-based backed asset. And the old saying in real estate, buy the best house and the best street if you can. Well, in agriculture, you want to understand the asset. You want to understand that land-based asset, and whether that's going to underpin the business that you're going to be running on that particular asset going forward, and whether that's got the capability to support the numbers you want to hit in terms of production. So that's another thing we say. When you're doing your due diligence, make sure you understand that asset that you're getting into, and what the climatic conditions are like, what its turn-off capability is like for cattle, grass as it grows, all that sort of stuff. So that'd be my comments on it.
Yeah, brilliant. Troy, hang on one sec.
Just on the other side on returns, which is probably interesting. If you look at a lot of the big institutional super fund type investors, and you look at some of the big family office investors that are in agriculture, they're actually in agricultural farming, cropping land, and they take very little, if any, exposure to the operating performance of the business. Westchester is a really good example. They buy large amounts of agricultural farming land. They charge a rent of somewhere between 4 and 8%, guaranteed cash flow. They get capital upside, they get capital downside, but they really avoid the operating risk for a lower return. And you see lots and lots of people who want to invest in agriculture who get through the complexities of it all, and they allocate capital to lower returning fixed return land that there's a good capital upside on, and then you see higher rates of rent on things like feedlots, abattoirs, further valuating assets, almond orchards, those sorts of things that have had more capital allocated that actually come up higher. But, if we sit back and look at the really big lumpy investors, a lot of them don't take any operating risk. They outsource that and then lease the land out.
Brian, have you seen a fair bit of that in the transactions that you've been involved?
Yeah, absolutely. I think I always get a bit nervous about these sorts of discussions because, I'm an advisor. I sit on the sideline and I don't take on any risk, and so I feel a bit
That's a smart way to do it.
You always get paid, don't you?
I wasn't going to say that, Troy, but that's where I was going. But we've seen, we're very fortunate in that we act for very successful institutions and producers who do have some unique circumstances to be able to realise opportunities. So they can be patient capital, and they've got plenty of capital. And I was just thinking, sale and leaseback is a good one. I always say to people, we advise often on two sides of the fence. The debt constrained or the debt drowning producer with all the expertise in the world but no money, or the institution with no expertise but all the money in the world. And so we say, why wouldn't you guys get married? Why wouldn't you do this together? So long as capital doesn't peer over the fence and say, look, I'm not too happy about the weight gain that I see in that paddock, and in return the producer not get upset that they've got to produce a report in a particular format, but take the debt, sorry for banks, take some of the debt out of the system, and that's the sale and leaseback model, and not have operational risk on an institution that's in New York, and just do JVs. Clever people have looked at, you've got to respect the assets, right? These are, we all the layperson thinks farming's pretty easy, right? You plant it and you wait for the rain, or you let the cow eat the grass, they get fat, and that's what it is. It's such a complex, these are such complex assets, and it's such a complex industry, and to do it well, you have to be really, really clever, and our sector is really clever here. But now people are coming through and looking at how to peel the onion in different ways, which we talked about. Some people are looking at land. You know, there's a great story of, I won't, some people are looking at land, not for what it is now, but for what it can be. And it's a development play. It's not like, you know, taking the double block, splitting it down and putting on townhouses. Now, we probably don't want to see that happen to all of our, you know, some of our regions. We don't want to see change for use or whatever. But clever investors are doing that. And so there's a whole bunch of ways. Those and purchasing good assets. It's old and trite, and it's sometimes not said in a terribly complimentary way. But the top 20% of producers, you know, they've managed to get onto a good asset, recycle into another good asset, and returns are astronomical. It's the poorer performing assets that, you know, create problems. But the returns are there, and you know, it's been said, so I can't really add. But capital growth has been phenomenal for a lot of assets.
Can I just ask another question, just on how do I invest in agriculture? So we've clearly talked about, you know, private offices. We've clearly talked about institutional investors, and I'm sure some of those are represented both here in the room and online. But what about for funds and others who are looking at, you know, I don't want to actually own an asset at the bottom end of this. Has Australia's, you know, listed and unlisted, are there good options in terms of being able to get access to this asset class without having to be, you know, make a ginormous play for a lot of funds? Troy, I might ask you, given the backing you've got, it gives a bit of an interesting insight. But
I've worked in a couple of listed agribusinesses before. So there's not huge amounts of listed agribusinesses in Australia. There's not huge amounts of listed diversity, but there's enough there. And some of them have performed really well. There's a couple of water listed water assets. There's some listed land assets. There's some land and lease. There's some couple of, you know, one that's got a lot of exposure to cattle. And then there's farm services. There's, you know, Elders being a big farm services. There's a transaction at the moment going with Delta. There's chicken businesses. You know, if you think about agriculture and you look past traditional farming, post-farm gate, there is so many asset classes, so many parts of agriculture to invest in, whether it's direct or indirect. And it, you know, I look at some of the, you know, some of the things that my owner invests in agriculture, and their biocontrol insect startups and their tech startups, and they're not the traditional land and agri all of the time that we think about. There's also a couple of groups that will do, there's non-listed exposure to a whole lot of listed products, and you can invest in those funds. And there's quite a few agri funds that are either commodity specific or region specific or broad and diverse that you can invest into with, you know, to be brutally honest, without a lot of money. But you've got to do your homework. You've got to be careful. You've got to understand the risk like you would with any product. And I think with agriculture, even more, you've got to be comfortable with and back the management, or not back the management. And it's not that there's necessarily bad people out there. Agriculture can be complicated. We get droughts, floods, fires, market movements, and you need people who know what to do and can move quickly and have got some experience in that if you're going to invest in those groups.
Brendan, did you want to chip in on that at all?
Actually, I think Troy covered it
pretty
pretty extensively there. There's really not much to add on that.
Hang on 1 second. I'm just going to, for those playing along at home, I'll bring you a microphone.
Ben Forrest, I was just wondering, Troy, do you think a listed company like your AA company is ever going to be able to compete with a private such as yourselves? I mean, what's it going to take for the listeds in major land holdings to be able to be efficient investments that deliver returns, do you think?
Thanks, mate.
That sounds like a free kick for you, mate.
We're not the cheapest operator because of our size, and there's some diseconomies of scale with governance and things, but also our owner has a very long-term view and has a risk-adverse view. It could happen, but we don't have an animal welfare problem. We don't have an environmental problem. We want to invest in staff. We have some metrics around retention and investing in people that mean we run a few extra people and we do a bit more on the environment. So yeah, we probably won't be as lean as some family operators. What we're seeing though is the rise and growth of what I call a family corporate. They've got a couple of $100 million worth of assets. They're either usually in cropping or central Queensland beef. Got multiple properties, really smart family members that live in those areas, they live in regions. No disrespect to anyone in this room or ourselves, they don't spend a lot of time at places like this. They spend a lot of their time on the front line, walking through the crop, walking through the cattle, looking at their financials. Bentleys do a lot of work for those family operators they're absolutely on the tools. They've got multiple properties, they've got corporate governance around them, but they're lean and mean with good economic and good legal advisors and environmental advisors. Jumping back to, I suppose, the pointy end of your question around non-dividend paying listed entities, having worked for one for a period of time, and we were, it's easy to say we were about to pay a dividend and I left, but the challenge there is just any stock in Australia that doesn't have substantial capital growth year in, year out, that doesn't pay, is going to struggle if it's not paying a dividend. And you could argue that those stocks that don't pay a dividend in agriculture and don't have a lot of predictable performance and predictable capital growth are not going to grow in value. If you're in the beef space and probably in the cropping space, but not as much as the beef space, the most amount of money is made from buying and selling the asset. You buy it right, you run it well, you develop it well, you find the right time to exit and you exit. That's where you're going to make the most of your money. That's where your 7-ish% per annum compounding KO is going to sit. Your 2 and 3% is going to pay for that and pay for some capital development. If you're in a listed space and the company's not going to be sold and your shares aren't going to face some competition from someone who wants a takeover or to participate in takeovers, it's very hard to get that buy-sell value in those stocks, and I'd be careful at buying a stock that was like that if there wasn't that sell or realisation of the investment.
Can I just ask as a final question before I throw to Brendan to wrap up, and actually it's probably a question for you. What's the liquidity of the market like in terms of, so, talking about investing and holding it, running it better, is it relatively easy to divest at the back end, Brendan?
Look, in our experience, let's talk about livestock beef, for example. Some of those operators and regions that Troy had mentioned earlier, look, there's plenty of transaction activity that goes on in that particular segment of the market. From your small beef operator up to sort of your mid sort of size operator, 20, 30, 40 million plus operator. Plenty of liquidity around, and it also helps depending on the geography as well. If it's a good quality asset country, and good history of production, then like any other type of investment, it should do well and there should be demand for it. Some of the bigger, larger scale type assets, large properties, multiple hundreds of millions of dollars, millions of hectares, that sort of thing. The market does thin out. However, there still is a core group of people that are interested in those types of assets and are willing to transact for the right type of one. So, for example, we were involved in a transaction about 18 months ago, 18 months, 2 years ago, in the Northern Territory, in a cattle producing region up there, million plus hectares, 40,000 plus cattle. We ran a process for the client on that in terms of divesting that asset, and we had plenty of interest, and in the end it went for over $100 million. So yes, it does depend on the asset at the end of the day, but by and large, good quality assets, well located, well run. Like any other business, there's always a good market there for it.
Troy, you're looking at me with those eyes again, saying, "I want to have my 2 cents."
No, I agree with everything Brendan's saying, that the challenge is if you have a drop dead date and you need to divest, it can be challenging. So I look at our business when we did a soft sounding, did the whole build up of the corporate process, and then the 2018-19 drought hit, then the bushfires hit. And I was in the US, in the UK and Canada doing the sort of final pitch and the sale, and they're like holding up the Montreal Times with burning kangaroos on the front, saying, "Oh, the whole country's burning to the ground." And I've got my photos of trucks getting bogged in the Northern Territory because it was cyclones and raining up there, and then you get something like COVID, and everyone thinks that the market's going to crap itself at the start, and asset values are going to fall, and then it does the wrong thing and it goes the other way, and investors get all spooked and all stirred up by that. So you see assets sell cheaply sometimes when they've got a drop dead date that they have to sell at. Those that can manage through a cycle of environment, or those that can manage through something can actually, there's a fair bit of liquidity there if you're patient and you can line up the right macro and micro themes.
Brian, do you want to dip into that one?
Yeah, I've thought about, again, from the sidelines, I think about this a fair bit, but, hopefully I used this word before, patient capital. Patient capital will do well in agriculture. If you look at it, as a wealth creator throughout Australia's history, agriculture has been phenomenal. And a couple of examples I think of, and everything Troy says about the listed base is of course correct, and timing's an issue, but there has been exposure to investments in the listed space. There was a company called Prime Ag which bought up, was ahead of its time. Peter Corish, famous cotton grower, was ahead of his time. Prime Ag might have sold 14 or 15 years ago. If he was selling those assets today, just no comparison. And there's another one, Sustainable Ag Fund. Sorry, the key point of this is these groups put together very, very good assets, and both of them, careful what I say here, had investors who, to use Troy's words, got spooked. If they hadn't have got spooked, they would be singing from the rooftops about agriculture as an asset class. They would have been doing what Larry Fink said, put it in the bottom drawer and go to the beach, but they didn't. So there are plenty of ways to invest in the space, but as my point of view, as a wealth creator, as an asset class, there is fantastic opportunity if you take the right ones up and you're patient capital and you're well advised. So.
Yep, brilliant. Just before I throw to Brendan to give some closing thoughts, can I do 2 things? One is I'm going to use my favourite agricultural statistic, and that is that UK investors own more land in Australia than there is land, and more agricultural land in Australia than there is land in the UK. That's the first one. That's one of my favourites. So I'm not quite sure why Britain hasn't moved here yet. I mean, we've got enough land for them already. But the second thing I want to do is ask everybody who's in the room, and those online, we can't see you, so feel free to applaud at home or in the office or wherever you are, but to show our appreciation of the panel's thoughts and sharing your insights. Really do appreciate it. I found that really fascinating and useful discussion. I hope everybody else has as well. But Brendan, keen to throw to you to give some final thoughts.
Sure. We've gone way over time, so I'm quite surprised everyone's still here actually. So thanks for hanging around and listening in and listening to particularly these 2 guys here, great panel members. Look, it's on behalf of Bentleys, we've been really, really happy to have been able to get today to where we've got to today. I've been talking to Paul Wright at ABCC for, as I say, about 2 years about doing this, and look, it's just been great that despite a pandemic, we've actually managed to bring this to fruition 2 years later, so better late than never. So big thanks to ABCC, David, and also Samantha Reichman here, ABCC chapter manager up here in Queensland. I think Paul Wright and Jenny Garber, your colleagues, are there online as well. Thank you very much for doing the very aptly British thing of keeping calm and carrying on and getting it done today. So thank you. Also, enormous thanks to Troy from CPC for a huge amount of his time and excellent insights. I think from a commercial operator like Troy, it's always good just to sit back and listen to their view of the world, and you generally learn a lot out of that. So thanks, Troy, for that and offering that up today, especially some of your comments around ESG and and FIRB in terms of your experience. I think really adds a great practical layer and context to the discussion. So thanks for that. Special mention for K&L Gates, our co-sponsor today. Thanks for getting involved and shouting some drinks at the end. And Brian, for your inputs and insight on the panel here, especially around FIRB and the process around that, and how you let us know you're a natural hedge to the whole transaction process by sitting on the outside and getting paid at the end. So that was good to hear as well.
I said I was on the outside. I didn't mention getting paid. Somebody else did that.
So your experience and insight in the sector in terms of the types of clients that you work with adds an extra layer of an extra lens in terms of how they view it as well. So thanks for your contributions today as well. So thank you again. I know I'm seeing between you and the drinks, and I think it's Moe that Brian's putting on today. And I think it is. Maybe it's Bundy Rum. I don't know. But look, thanks again to all of you for coming along. It's been great that you've taken the time out of your day to come and have a bit of listen about agriculture. Obviously, we're all very passionate about it. At least we live and breathe it every day with our clients. It's an area we think there's enormous opportunity in moving forward. We're really excited about the UK and Australian relationship and deepening that relationship through the FTA going forward, and the opportunities that's going to create, we hope, for agriculture moving forward. I'm sure there will be, both on the trade side, but then with the investment side, hopefully to follow. A big part of that is you, David, as well, being a champion for that relationship and your tireless efforts to make sure that is front and centre of the conversation between the two countries. So a big thanks to you as well, and your contribution in keeping us sort of all aligned and on track today. So thanks to you as well. So thanks, everyone. Let's go and have a drink and chew the fat a little bit more.
Brilliant.